time for Financial Friday. Limehouse Financial is helping us better understand the steps needed to make your retirement successful. Today, we're going to be talking about taxation during retirement. So joining us is Tripp Limehouse, president and founder of Limehouse Financial. Thanks so much for being with us.
Hey, it's glad to be here with you again.
Yes, and of course, we do always ask for viewers to call in with questions that you'll answer on air, and we want to start with those questions today. Michael in Blythewood says, I just retired with a pension and a TSP. We still have some earned income, which I'm throwing into a Roth to pay for our 2 children to go to college in a few years. I'm pretty late to the Roth game, and at this point, all my retirement money is taxable. So in 4 years, when I need $30,000 for tuition, would I be better off taking from my taxable retirement and letting the Roth continue to grow tax-free? I just want to do this right.
Big question, a lot of riding on that, right?
Yes.
He's got retirement in the mix, got college education in the mix. And you know what we see is a lot of people are just like him, and they're looking towards their retirement accounts to maybe fund education for their kids. So the first thing I'd like to share is that we probably want to always keep those two things separate. So retirement is for retirement, and then education planning is for education planning. But I think what he's after kind of ties into an income and a distribution plan, which we've talked about on the show a couple different times. The key thing there is knowing where to take money from at what time, and then of course making sure it never runs out.
Right.
But I'd say under this scenario, so just retired, so perhaps if we can keep him under a certain threshold for tax bracket wise, pulling out of the tax deferred accounts would be the preferred method, maybe even more so than the Roth. So it could be a combination of each. But there's really no set answer, because what has to occur here is the same thing that needs to occur for everybody, and that's a plan. You know, we have clients and they have kids who are getting ready to put through college. Well, what we're doing is we're building them the retirement roadmap, and as a line item in the plan, we're accounting for education funding, and then we're making a very specific recommendation on where to get the money from to fund that education. So that's the same thing that we could do for this person.
Deborah from Chapin says, can you explain the living benefit on life insurance? I've never thought of life insurance as anything but a death benefit, so I'm curious as to how that works.
Oh, wow. I tell you, she's been kind of looking at some things.
Yeah.
That's a good one. A great question. I love these questions because sometimes people ask a question that somebody else might be wondering about but might not ask, and then everybody's like, oh, there, you know. So this is very helpful for our viewers. All right, life insurance and living benefits work like this. Life insurance is the primary function of life insurance, a death benefit. You pass away, it pays to the beneficiary. But life insurance companies got creative not too long ago, and they started offering accelerated death benefits. So a living benefit for a life insurance policy works like this. Let's just say someone has a $100,000 life insurance policy, and the insurance company says, in the event that you need long-term care, you can accelerate this death benefit by 4% monthly. That would equate to $4,000 a month coming to the person that they would then use to pay for or offset the cost of maybe long-term care or assisted living or something like that. So what happens is the life insurance death benefit, Madeline, it decreases over time. So going back to the 100,000, if they accelerate 50,000 of it and then they die, well, 50,000 is paid tax-free to the beneficiary. So they use 50,000 while they're alive. That's the living benefit part. They die, 50,000 goes to the beneficiary. So a life insurance policy with the living benefit is a great way to do kind of two things at one time. Make sure you are covering what's needed to be covered for a death benefit, right? It could be to pay taxes that are due on an IRA or something like that, but also it could be used to pay for something that a person might need while they're alive. So life insurance can not only be used for a death benefit, but for a living benefit. Just think of it that way, accelerating a death benefit for you while you're alive to help offset medical costs.
Very interesting. Our last question for today, before we get into our topic of taxation, Stan in Irmo says, is it possible to roll over a simple IRA to a Roth IRA?
Well, it sure is possible. You just need to do it the right way, because simple IRA is tax deferred, has never been taxed. And if a person wants to take that money and put it into a Roth, they can. But what has to happen in the middle is taxes have to be paid. So you take the money out of the simple, you pay taxes, and what's left you put in the Roth. The answer is yes.
All right, and we want to talk about a very important topic. What is taxed during retirement?
Oh gosh, well, I think that's the hot topic right now. Taxation and retirement, what's taxed? Social Security is taxable. If a person receives dividend income, it's taxable. If a person is receiving rental income, it's taxable. Just think of any sources of income that are going to be put on that tax return, that's all going to be taxable.
Okay. And so how is Social Security taxed?
Well, Social Security is not taxed in South Carolina. That's good news.
Okay.
But at the federal level, it is taxed. So it's either going to be either 85% of your Social Security would be taxed, 50% will be taxed, or 0 will be taxed. So that's how taxation on Social Security works. And there's also this thing called provisional income. So we have to very carefully calculate how all this plays into account for people at any time and at all times during retirement. We just can't escape taxation, and that's why we talk about the tax-efficient retirement plan.
And IRAs were a big topic in our viewer questions today. Are all IRAs taxed?
Oh, this is perfect timing because we're right now approaching the deadline to file for your taxes. And folks, if you didn't already know this, a person, Madeline, can open up an IRA with us right now, put money in it for last year. And so a lot of our clients are coming in now looking at what they have done, what they need to be doing, updating their plan. And then a lot of new people are coming in right before this tax deadline and saying, hey, can you help me open an IRA and fund it? And the answer to the question is you cannot escape taxation on IRAs because there's a partner in your IRA with you that you might not realize. It's the IRS.
Okay.
Yeah. This is really, don't forget this. Your IRA is really an IOU to the IRS. That's what it comes down to.
Okay.
You didn't pay taxes, the money went in, it grows tax deferred. When it comes out, it's always taxable.
Okay. And what is a required minimum distribution and when does that start?
RMDs, well, that partner that I just mentioned in your IRA, the IRS. So essentially, people are entering into a relationship where they're agreeing to defer taxes and then take money out whether they want to or not at a later time. So it's age related. It used to be 70 and a half, and then the Secure Act passed, and then the Secure Act 2.0 passed, major pieces of legislation. Now it's 73. So a required minimum distribution is the point in time when somebody has to make a withdrawal from that tax deferred retirement account. It starts at age 73. It's going to be pushed out to age 75. But you can't get around it. You are forced to take out withdrawals. And for some people, that's really frustrating because they might not need to take money out, but they have to.
And how will the Tax Cuts and Jobs Act piece of legislation expiration affect people, and when is that set to take place?
So the Tax Cuts and Jobs Act was enacted by our last administration, and it's expiring on 12/31/2025, so it's going to be happening quickly. And when that happens, we are going to be paying higher taxes. Standard deductions are going to change. Things are going to revert back to pre-legislation. So we're just telling people, prepare now for higher taxes in the future in retirement, which is contrary to what they think they're going to be doing. A lot of people think they'll be paying less taxes, and that's just not the way it works out.
Definitely. If you are looking for more information from Limehouse Financial about all things retirement, you do a lot of live events. You also have the Road to Retirement show right here on WIS on Saturday mornings at 6:30, right?
Yeah, tune in tomorrow morning, 6:30 a.m. right here on WIS, the Road to Retirement show with Limehouse Financial.
Absolutely bright and early. And of course, we'll be here every Friday with Financial Fridays. We'll be right back.